Hello and welcome to yet another instalment of our Nucleus Wealth Insight series. Just a quick reminder that the following presentation is general information only and does not take into account your personal circumstances. Whilst Nucleus Wealth aims to present informing and sometimes entertaining content, please consult your investment professional, financial advisor, or better yet, speak to us before making any decisions based on any of the themes discussed in today's presentation. And don't forget that this is a live presentation, so feel free to drop any questions you like in the chat box below and we can answer them along the way. If you're watching this after the event, make sure you attend the next one so you too can participate in the live Q&A section of our presentation. Our presenters today include myself, Tim Fuller, a certified financial advisor who's worked with hundreds of clients over the years, helping to make the complex simple for companies such as AMP, Mercer, and independent advisories. We also have David Llewellyn Smith, co-author of The Great Crash of 2008 with Ross Garneau, founder of the internationally acclaimed Diplomat magazine, and now chief editor of the enormously popular Macro Business Financial blog. Finally, we have Nucleus Wealth's Head of Investments, Damien Klassen, whose 25 years in the world of finance has seen him as the founding partner and head of research at analyst firm Aegis Equities, head of quantitative strategy at Wilson HTM, and was responsible for mining, energy and big data in the $60 billion global quantitative equity fund at Schroders, who are a multinational asset management company. And for more information, please check out our people section at www.nucleuswealth.com. So, hello and welcome to our next instalment of Nucleus Insights. And today we're going to be looking at all things China. So we've decided to look at three areas: the triple threat of China. And so, with no further ado, we'll jump into it. We've broken up the three areas of focus today into fighting the Fed, the Trump trade war, and then finally having a look at debt. And then, as always, of course, wrapping it up with investment implications and where we're looking every day at Nucleus Wealth. So I'd like to invite and introduce, of course, David Llewellyn Smith, sitting on my left-hand side here. Hello, David.
Hi, Tim. Thanks for having me.
That's okay. And we've got Damien in the corner as well. G'day, Damien.
Hi, Tim.
Sure thing. So let's jump into it. China. So where is China now? A quick recap of some stats, facts and figures to bring us up to speed.
Yeah, just to set us up before we move into the triple threat. The first chart there is the growth internals in China. As you can see, they've been ebbing and flowing for years, but trending down, especially sort of since 2011. And that's unchanged. Probably the most important 2 points to note on that chart is very recently you can see quite a sharp deceleration in fixed asset investment. That's infrastructure and real estate, and is the key sort of top line measure for Chinese building.
Sure.
And a sort of material drop in retail sales as well, which we're not sure if that's going to be sustained or not. But you can see at least the fixed asset investment component is slowing in trend and more quickly recently.
And also that's a key thing we're watching for in terms of the rebalancing side. So we know China's spending far more on capital expenditure than pretty much any other country has ever done for such a long period of time, and which means unproductive capacity, and you're building your third airport in the region where the other two are already underutilized and things like that. There's only so much you can keep doing on that, and so the key measure we're looking at is for the Chinese economy is rebalancing is actually getting that number below and significantly below GDP, because the only way you rebalance is if you're either not growing or negatively growing that side of it, and meanwhile your retail and retail spending and your consumer side is actually growing. So you sort of get let's say it averages out at 3 or 4%. Chinese GDP growth is that you want 0 or negative for capex and 7 or 8% for the consumer, and that's a nice comfortable transition as you move from capex led growth to consumption led growth.
And they have actually almost equalised now. So they're in the mid-high sixes, both of them.
So things aren't getting worse.
So they finally managed to not get worse. But if you want to move on to the next chart, you'll see that they may actually be able to drop fixed asset investment further in the coming months, because this is the leading indicator really for Chinese growth, and particularly construction growth. That's China broad credit, which we show fairly regularly. You can see that it's been dipping now for well over a year, and is now actually the lowest point that anyone can remember. But a lot of that is kind of high level fluffy bank interbank debt and things, which will slow, but not as much as some of the real economy debt. In other words, where is China now? Well, it's slowing, and it's going to slow some more. Next chart will show you that if we break some of that debt up, you'll see that this is where the infrastructure slowdown is coming from. Big slowdown in government bond issuance after the recent stimulus. Same with corporate bonds, although they've picked up recently. And that's really where a lot of the slowdown has come from so far.
Yeah, and so just to put that for people who are listening in, so the government, Chinese government spending sort of ran at sort of 15 to 20% debt growth for whatever it is, 5-6 years from 2010 sort of out to 2016, and that was when we had that when we had the Chinese slowdown, and then it took off and grew at sort of 50% plus for a year or two, and then that's faded off, and it's now headed back down towards 20%. But in the meantime, we've seen that the corporate side has been slowing much faster, and that's sort of down sort of below 10% at the moment. So there is there's obviously that conflict again between how much of it you can only, centrally led planning can certainly push projects, but if you haven't got that sort of underlying corporate demand to actually get out and grow sort of more projects that are going to give you a better return, then obviously it's a lopsided sort of growth that's relatively limited.
Yep. And so next chart is household loans, and that's basically mortgages, and that as you can see is also tailing off, but is trailing some of the other measures. That year-on-year growth is still not too bad, and we're seeing a housing market there where some large areas of house prices are still rising, and residential construction growth is still up year-on-year. So I expect that will continue to diminish as well, but we're not yet at the point where that's falling year-on-year.
And it's worth noting as well that the Chinese consumer is a lot less indebted than most other, or most certainly Western consumers.
Okay.
And so if you had an idea that things were slowing and you would like to prime pump the Chinese economy with more debt, chances are you'd probably be trying to work out how to get Chinese consumers to borrow more, because they're not as indebted as governments and other sort of corporates are over there. So that would be, most of the spending we've seen over the last 10 years has all sort of been this capital expenditure for big projects. If you're going to see a reversal, but still lots of debt, then
and could this just be the natural progression of things though, where we've seen obviously the capex side, the corporate side, and then as I guess the continent becomes a middle class continent, then it shifts into housing debt. So people start, the potential for a housing boom potentially if they want to let the debt.
Well, they've been doing that anyway. It's been off the hook since the GFC.
Yep.
Like the massive sort of ghost cities and three, as you can see, 3 spikes and 3 booms basically over the last decade, all of which triggered 3 credit booms, and all of which triggered big surges in residential building.
Mm-hmm.
So they actually moved on that quite early in their development, as it were. So yes, there's more scope for it to run again, but there are constraints on that as well, because it's already very expensive Chinese property, and there are political considerations on that. One of the reasons we're seeing this slowdown in Chinese property prices is Xi Jinping declared that Chinese houses were for living in, not for speculating on, because he was feeling those political pressures. That's not to say that they can't be ramped up again. They could, as Damien said, but it's not all one-way traffic.
Sure.
So the other thing to note is that it's when you've gone through your stages of living, if you're sort of in a subsistence style living, and every single dollar you're getting is going into just paying for just staying alive,
for living, yep.
And then eventually as you get richer and richer, you start to spend more on status goods and services. And so I think in a Western economy, there's nowhere near as much of your income needs to be devoted to clothing you and feeding you and things like that. So you then get to go, well, let me buy a bigger and bigger house to improve my status type thing. Whereas I think in China, as they're more of a middle income country, and so as they grow and they increase incomes there, then the scope for them to spend more on housing is certainly there in terms of if you want to lift your status and you want to. You get another $1,000 worth of monthly income, and you can then put that into a higher, buying a bigger place, or even
levering it up essentially,
buying the same place for more money because
you've got more money.
Prices have gone up. Yeah,
and just that's actually a note. I'm not sure if you've got any data on this one, but wage prices, I guess, have been you read about Chinese wage prices rising, and so obviously that's giving the leverage effect potentially on lending.
Yeah, I mean, the income growth has actually been slowing over the last few years, and that's partly the result of what Damien was referring to before, where you've got a lot of unproductive debt starting to really choke economic growth.
Mm-hmm.
And, the outcome of that is productivity falls and you start to lose your income growth.
Mm-hmm.
That said, it's still running at a pretty good clip. So, there's rebalancing on that front as well. But the main point of all that first section and those slides to take out is that China's has been stimulating for the last sort of 2 years and is now slowing.
Okay.
And
sure.
And so into that, we now move into our first threat.
We do, fighting the Fed.
Of the triple threat, which is what China calls the grey rhino, and that is fighting the Fed. And the first chart here to show you is you can see this is an aggregated chart of emerging market currencies by JP Morgan, and as you can see, it's just been absolutely falling out of bed for the last couple of months as the Fed has raised interest rates and the US dollar has started to rise as a result. Now, the US dollar is rising for any number of reasons. It's not just the Fed, it's US leadership, European endemic European political problems.
Sure.
And slowing, Japan still struggling, etc. It's just sort of become the only game in town, the US economy and the US dollar. And so what happens when the US dollar rises and the Fed hikes and you get this very large yield spread differential, that is higher interest rates in the US than anywhere else?
Mm-hmm.
All the money in the world starts to chase US dollar assets, and it flies out of emerging markets most quickly.
Sure. Okay.
And what that does is tighten monetary conditions in emerging markets intrinsically.
Sure.
So as money flows out, their interest rates start to rise, and central banks try to step in and stop it turning into a rout of the currency. And you've seen crazy interest rate hikes in Turkey, Brazil, Argentina, all sorts of places that are trying to arrest this process. But it really is, fighting the Fed for emerging markets is extremely difficult, if not impossible.
And it's worth noting with that chart as well is that the Chinese currency, which is, if not the largest, if not the majority of it, certainly the largest country in that index in terms of the weighting.
Yes.
But it's the least volatile. It
is
more pegged to the US dollar. So if you took out the US currency and said, what about it? Sorry, took out the Chinese currency of that basket and said, what happened to everything else? That line will even be considerably more dramatic.
Yes. Yep. It will. But if you move on to the next chart,
sure,
you'll see that despite what Damien has said with that much greater stability in the yuan, excuse me. Thanks.
The perils of a live audience, live show.
The recent few weeks, what this next chart shows, this is quite a dynamic chart, shows that basically capital outflow has now taken off, or has begun to take off in China in the last couple of weeks. So some of that emerging market contagion or panic or just capital outflow, whatever you want to characterise it as, has started to hit China. Now, this, you might want to go to the next slide. This starts to raise a really difficult situation for China to address. The two key components here to discuss now is, in the first section we noted that China is slowing, And now we've noticed that the Fed is tightening because the US is so strong, and the emerging markets are seeing a lot of capital outflow, increasingly in China as well. So that poses a huge conundrum for China, because obviously, the classic logical response to their slowing economy would be to cut interest rates.
Sure. Yep.
But they can't do it. If they did, then they would see capital outflow
Even faster.
accelerate very quickly. Now, this is called the impossible trinity. Basically, the authorities in any country can basically not control all three of interest rates, capital flow, and the value of the currency.
Okay.
It can only control two of any of the three at any given time. So that means China can't cut interest rates. At the same time, because the Fed is hiking interest rates and China is pegged, the yuan is pegged to the US dollar, even if it doesn't cut, it's cutting by default when the Fed hikes.
Okay.
Because it's pegged.
Sure.
So it's this is why it's starting to see accelerated outflow, because it's stuck on this conundrum. So what can it do to try and stimulate or stop it slow down getting too bad, which could then actually trigger more capital outflow?
Yeah, and actually, before you go too far, it's actually worth noting with the Trinity is that China has a bit of a different model to most other places. So most other places have freely floating currency, and they move the interest rates and relatively free capital accounts.
Sure.
Whereas China try to control the capital account and the currency, and then the interest rates are sort of like it's a mixture between. All three of those, they're trying to control one and then control the other and then control the next.
Yeah.
And whereas most other countries are sort of relatively freely traded and just let the market balance to where it will.
Yeah, that's right. I mean, it's a dirty float basically of the yuan, and yeah, Damien's right. It's a sort of half pregnant mix of these tools in China, arising largely from the 2015 crisis, which this is kind of a rerun of, where China was forced to shut a lot of its capital account because the capital outflow got too extreme.
Too big, okay.
And the falling yuan was blowing up the world economy. Because when it falls, the emerging markets around it start to get hit by competitiveness problems, as well as being hit by capital outflow from the Fed. So they have a double whammy. And that really causes markets to puke.
Yeah, sure.
Basically.
Yeah. And what you tend to see with China is that it's a little bit of let's try this lever. Oh, that didn't work. Let's try a little bit on this lever. Now let's try a little bit more. And now let's just take that to
11.
Give to 11, and then let's try these other levers. There's a lot of little movements, and you do notice that reserve requirements and interest rates and capital.
Yeah, that's right.
Have we got lots of capital controls on, or have we got sort of notional capital controls we let people skirt a little bit, or when do we crack down, when don't we crack down? Sort of it all comes back to that same.
That's right. They're juggling a million balls at once, right, to get this right. So you can expect them to probably cut reserve ratio requirements again. This doesn't do much. It frees up a little bit of lending, but it's very minor. When you look at reserve ratio cuts versus previous slowdowns, they really did nothing.
Yeah, right.
To slow the slowdown. The PBOC is also easing money market rates a little, kind of cutting interest rates by default. Fiddling around with repo rather than doing the cash rate. That's been effective at lowering rates somewhat. They can do more fiscal stimulus. At the moment, they don't look too keen on it, but they can do it, and if things really got out of hand, I expect they would. They could also lift some of their macroprudential controls, which are, what has played a big role in slowing the housing market so far in this slowdown.
And by that, it's like limitations on how many houses you can own, or increasing tax rates on various, making sure you need to have a certain amount, 40% down or 50% down or whatever, different limits, and they often that differs between cities and regions, and so there's a lot of little macroprudential things that get played out all the time.
Yeah. So you got to remember though that all these easing actions have consequences, and as capital flows out, that tightens the availability of credit intrinsically again. So they're fighting this, as Damien says, they've got pulling all these little levers, and every time they pull one, something else, it's like holding a balloon in your fingers, right? You push it back in and it pops out the other side. But so if you go to the next chart, anyway, they've had some success so far. Like the Chinese slowdown has been mitigated a little over the last 3 or 4 months with, you know, some of this slight easing in credit. This is Chinese house prices. In recent months, there's been a bit of an uptick in the number of cities that are seeing rising prices. It's not runaway by any means, but, you know, kind of third and fourth tier cities, which actually comprise, you know, roughly 80% of the floor space in China, so it's a big deal.
Yep.
Are now running at, you know, kind of 5-6% house price growth, which has been enough to keep construction running as well. And that's on the next chart. So construction starts, you'll see there in May, were actually the highest May ever, even though they were down in earlier months of the year. So it's, you know, they've already kind of tapped the accelerator a little bit in this process. And
having said that, though, so we're the highest May ever, but June's traditionally a much stronger month, and it had a weak-ish April. So
yeah.
You know, quite possibly you've got to bring forward from one or
of
bring
course.
back or whatever.
So I'm not saying this is a boom by any means. I'm simply saying they've just tapped the accelerator a little, and you don't know, like this might have transpired anyway. Like
and what I guess where I'm getting is it might actually be the start of a big push on the housing and construction and all that type of stuff. We don't think it is. We think it might just, at the moment, for my part, it could easily be a bring forward or a delayed from the prior month. But it's certainly an area we need to be watching to go, right, if the push is back on in terms of this, and there's a concerted construction effort, which, you know, as I said, record May could be the start.
Showing some signs.
So that's certainly something that we're not expecting them to do, and we'd need to have a look at our investment holdings and what we're doing in terms of if China seriously wants to push the foot to the floor again on the debt and the housing construction.
Okay,
yeah,
sure.
But there isn't enough evidence for that yet.
No,
not by a long way. What's been done has been relatively minor. I'd be more inclined to just put this down to the ebbs and flows of the market than anything much. You can just basically see the PBOC is trying to secretly ease.
Okay.
You know, not much more than that yet.
All right, sure thing.
So we're going to move on to our second threat now, and this will actually be somewhat circular. We'll kind of wend our way back to the Fed from trade wars, but I'll hand over to Damo to handle where we're at with the trade wars.
Yeah, so the big issue with the trade wars is just putting it all into perspective at the moment. So there's certainly some big figures being battered around, and I just wanted to put that into to what that actually means for the economy. So the key thing to note is that the US does have the advantage in these trade wars. So US exports to China sort of sub 200 billion, about 1% of GDP. And Chinese exports into the US or about 500, so considerably bigger, sort of two and a half times the size. And also because the Chinese economy is smaller, it's a much larger part of the Chinese economy.
Yeah, okay, that makes sense.
So the types of things you get is, so the biggest thing from the biggest export from the US is agriculture, but there's also a lot of sort of high-end machinery, aeroplanes, things like that are actually quite difficult to substitute. The agriculture not as much, but so if you saw, I guess I tend to think of the way tariffs work is, you're not putting places out of business generally, and you're not. What tends to happen is you get a bit of a shuffle around of where things are going. So if the Chinese put up their some tariffs on US soy, US soy ends up going to Europe, and Europe, more soy that would have gone to Europe ends up being shipped to China. Everyone spends a little bit more on transport, and somebody somewhere, lowest cost, the most expensive producer somewhere goes out of business. Probably not the US or China, but it's sort of that whole flow-on effect. So the thing, I guess, where I'm getting to from that is, so the US stuff is the agriculture is relatively hard. It's a lot harder. If you're buying planes, you can pretty much buy them from the Boeing, or you can buy them from Airbus. both of them have very long lead times and all that type of stuff. You're pretty much locked into where you're getting them from. And the high-end machinery you're getting from the US it's not like you can turn around and go, well, I can't get that from the US. Let me go to somebody who makes that. Let me go buy an Apple iPhone from somebody in Vietnam instead. Is saying, well, it's actually not.
There's no second option essentially.
Yeah, or much more limited second option. The reverse is not true. So from China, the imports that the US get from China tend to be lower end and more easily substituted.
Yep. Okay.
And also, but again, there's probably that being such a large consumer as well in terms of the US and such a big part of Chinese GDP. It's a lot harder to find consumers that are going to buy these. So if you've got a demand for soybeans, you'll shift around and get it from somewhere else.
Yep.
But if you're being locked out of markets or for lower end machinery, is that you've produced this machine and next thing the US is buying it from somebody who's made it in Pakistan or Vietnam or wherever it is.
Sure. Yep.
So, or you just had to export it through that country and you've ended up with lower margins.
Yep. Okay.
Okay, so so the US certainly had the advantage in terms of size and the type of imports and exports we're talking about. And the other thing to remember as well is, so the US was talking about, I think the latest number is 200 billion, is it? Or is he talking 400 yet? I think he's, anyway, so I think we're talking 200 billion.
It's it's another 200 on top of 50. It's 250.
Yeah. So so we're talking, so for 250, and it's talking about a 10% tariff. Now, some of these things will already have tariffs on there. So we're probably talking about a net hit of maybe $15 billion type thing. So it's a small, the actual effect is quite a small effect at the moment. So we're still talking, while the numbers might sound impressively big and they're designed to sound impressively big, the effects are not that big at the moment, but that's not to say they won't get bigger. So if you go to the next one, so the other thing to remember is, so we've got this rising US dollar, which has been playing out, and we're speaking about that. Now, if you're a US consumer and the US dollar rises, that means you can buy imports more cheaply.
Sure.
So if you've just had a 5% increase in the US dollar, imports are now 5% more expensive.
Due to tariffs?
Sorry.
Yep.
And you've had tariffs, add 5%, they basically cancel out. So you're in the same spot where you've cancelled out the increased tariffs with the rising US dollar.
Sure.
The reverse is true in China. So if you've got a falling yuan and you've got increased tariffs, then
it's a double whammy. It goes the other way.
Exactly.
Yeah, sure.
So again, it's coming back to that. The US has the advantage on that side as well, given where each country is in the trade cycle.
Yeah, that's fascinating. Yeah, that's good.
So then you go on to, is there a nice easy solution? And we've spoken about this a few times. Is that Trump's very fixated on the whole. How big is this deficit, this trade deficit? Now, if China happened to buy a lot more oil from the US, is what we said is an obvious solution, and now that the US is actually exporting oil, if China turned around and said, okay, well, let's just shuffle everything around, so some of the oil that's going from Saudi Arabia or Iran into China actually then goes into Europe instead, and some of the US oil that would have gone to Europe ends up going to China, is that net everything sort of stays the same in terms of world things, but the Chinese versus US, so China keeps its basically its current account surplus roughly where it is, but it just reduces it with the US at the cost of increasing it with other countries. Is that you might find that actually solves Trump's big problem, or at least it gives him a headline victory. Mm-hmm. The problem with there though is that you've got Iran and Trump looking at putting sanctions on Iran. And if they do that, then basically the only place Iran will be able to sell their oil to is India or China.
Or North Korea, maybe.
Yeah, that's right. So, when I say the only place, the big places,
the big ones,
the big consumers,
are just going to absorb any US impacts.
Is what. So that when the sanctions were on last time, that's basically what happened. Is Iranian oil ended up in India or China because they weren't concerned about
They're powerful enough to thumb their noses at sanctions.
Yeah, that's right. Whereas most of the big European companies, even though Europe itself would like to keep trading
oil, yep.
Most of the European companies also have big operations in the US, and so your Totals and those types of companies in that have
operations in.
Have
It's
operations.
essentially got to figure out where their butters, what side their butters,
and chances are, or certainly by the look of it, they'll go with the US. They'll go, well, we've got big operations in the US. Let's keep our US stuff happy.
Fair enough.
And certainly the stuff we've seen recently with some of the Russian companies being locked out of US markets and Chinese companies momentarily and being locked out, is that most of those, if you're a director of one of those big companies and you've got the Chinese guy saying we'd really like you to keep trading with Iran, and you've got the US guy saying, well, if you do, we're going to lock you out from buying US equipment and doing all this other stuff, you'll probably go with the US one.
Okay, fair enough. The upshot.
The final one, so the three things. US certainly has the upper hand in negotiating, and Trump knows this, and that's why he's making a big deal out of it, is because there's a win for him here. He knows he's got the upper hand. We're not talking about that meaningful yet, but the real risk is whether you get tit for tat and you blow out and you get these massive increases. We don't think China is going to do that. It has been cheating at the margin, I guess. Is it Trump's sort of saying, you've been cheating and you've been doing all these things and keeping currency low and all that type of stuff, and that's certainly true at the margin. They're chipping away bit by bit, and so to a certain extent, it's sort of is there look, we got our hand caught in the cookie jar. Okay, what's our penalty? Let's give you a bit of a win and move on. As long as it's not two-face. As long as we don't lose too much face, and we can buy more oil from you, do whatever it is to turn this into a win, and off we go. We suspect that's probably the way it's going to go. The issue will be if Trump decides that he really wants a huge public back down and you're the best ever, and you win, we lose type.
So if he overcooks his hand, essentially.
There's an additional trade-off now as well with North Korea, and the denuclearization that's been endorsed by Trump this week or last week. But this is a huge strategic gain for China if this transpires, and it gets to kick 30,000 US troops, Marines out of South Korea. And that deal is just sort of hanging there. And Trump immediately returned from endorsing the deal to put 200 billion new tariffs on, and so I mean, the leverage is obvious. Do you want your denuclearized North Korea? Then cough up on trade.
Okay.
So there's a whole mix of trade-offs in here between the G2.
Sure.
It's difficult to know how they will settle. Excuse me. So, you want to punch up that last chart?
We will. We'll jump into the third of the triple threats, being the debt. So
this is where they all come together, basically. So you have a slowing China. You have it wrestling with these different tools and how to offset it and not let it get too slow too quickly. While the Fed tightens, which is complicating all of that a great deal with capital outflow, and then you have Trump banging away at the trade account. So this means that China's entire external position is under attack, basically. So you have, for instance, one possible response from China to Trump, from China to the Fed might be to let the yuan. From China to Trump might be to let the yuan fall. And just say, okay, if you want tariffs, then bugger off. We'll just make the currency cheaper. But with the Fed tightening, it risks huge capital outflow.
Sure.
And this is where the debt chart comes in. The Chinese debt is very large in terms of percentage to GDP, but that we all know. But it's also got a considerable chunk of it, more than $1 trillion US dollars, denominated in US dollars.
Okay.
Externally.
Right.
Largely corporate debt. And so, if the yuan starts to tumble, all that debt gets a lot more expensive. And, this is where we go back to the dynamics we were talking about on emerging markets and capital outflow and the tightening Fed. Every time, emerging markets are the same, a lot of them have got US dollar denominated external debt. As their currencies fall, all of that debt gets a lot more difficult to service.
Yep.
and you get into a feedback loop where capital flight engenders tighter monetary conditions, which engenders capital flight as those debts become harder to pay. Now, what we're basically talking about here is the prospect of a Chinese financial crisis. Now, I'm by no means am I saying that that's our base case, but I'm simply observing the fact that, with Trump attacking the trade account and the Fed implicitly attacking the capital account, you do have conditions in which it will be very difficult for China to manage its external position. Mm-hmm. So, probably the best way of characterising that is we're in a high-risk policy scenario. So policy risk is very high right now around China. All those levers we were talking about, how they pull one over here and another over there.
And spinning plates almost.
Yeah, spinning plates, and they're furiously moving from one to the next. And it's just a high-risk scenario in which they pull one too hard and the other one explodes.
And the whole thing comes down.
Yeah, I mean, exactly right. So China in the period ahead has a very difficult balancing act. Don't get me wrong, I'm not saying that it's going to have a financial crisis. I don't think it is, and if it did, or it started to tip that way, it's got a lot of pretty heavy-handed stuff it could do to prevent it getting out of hand. But we are observing that the circumstances are in place where some of those risks become realistic in a tail sense.
Sure. Okay.
So then moving on to our keys, I guess, takeouts from today's discussion.
Implications for investments? Yeah.
Yeah, I mean, the upshot of that is I still think that bulk commodity prices are going to weaken.
Okay.
I think the balancing act of, the slowing of fiscal investment at the moment and the tightening monetary conditions in China, even though they've been loosened a little, are still enough for it to cause slowing in construction.
Okay.
I wouldn't turn bullish on commodity prices unless I saw a very explicit move towards more fiscal stimulus.
Yep.
And/or some push to remove some of the housing controls.
Yep. Okay.
The macroprudential stuff. As I've said, I don't think they can cut interest rates. I think that's too risky for them. I don't think things like cutting reserve ratio requirements, etc., are going to matter.
Okay.
It's not going to be enough to prevent the slowdown, I don't think. So I think, therefore, the outlook for commodity prices, which we've discussed many times, is still for them to soften through the second half of this year.
Have you seen any changes in inventory levels?
No, they're still very high.
Okay.
So that's obviously another bearish observation when it comes to these things. If it does slow, then the inventories destock, and so you'll get some nice price movements down.
Sure.
That said, I don't see demand collapsing or anything. It's still a slow slowing.
Okay.
But there is more supply coming from iron ore, so it's likely to be, I actually upgraded my forecast last week to $60 in the second half, but I think it'll be peeling down towards 50 by year end.
Okay.
And next year $50 looks like a better number. So that's coking coal will basically track iron ore, even though its fundamentals are better. So that means more falls in Australia's terms of trade. So I'll just skip to point 3. That means a falling AUD, especially since the carry trade right now is under huge pressure from the negative yield spread into Australia, where our interest rates are so much lower than the US, and what's really preventing a complete rout in the Australian dollar. For instance, the 10-year spread is at its lowest since 1984.
Okay.
And those are the kind of spreads that saw the Aussie below 50 during the millennium. What's preventing that from happening again is commodity prices are still quite high. So as they come off, I think the Australian dollar has some good falls ahead.
Okay. Yep. Sure.
And that's exacerbated as well by, we still think that the US dollar's got upside, and things like that comes from the Fed, but it also comes from the trade wars. The more tariffs that Trump puts on, the more the US dollar is going to correct upwards just to wipe them out.
Yeah. Okay.
because it's basically rising US inflation when you put those tariffs on.
Yep.
So some of it, no doubt, is absorbed in margins and what have you, but it will be inflationary. And the fourth point I want to make is these many levers that we're talking about that are being furiously pulled in China could result in either increased Chinese capital outflow or radically decreased. So, for instance, if China let the yuan fall, there'd be a lot more Chinese money floating around the globe. Now some of that would, almost certainly find its way into Australian real estate. So that's an upside risk, but I think the downside risk is the more serious one, because I don't think they can really let the yuan go.
Yep, sure.
Maybe grind lower,
Mm-hmm.
but they can't risk serious capital outflow. And if they get it, then they'll be tightening the capital account even further, more than we've already seen. I think that's the bigger risk of the two, and so that would mean less money for Australian real estate.
And the other thing to note is that Trump has been quite vocal about calling China a currency manipulator, which they haven't yet, but and then taking further action because they are manipulating currency.
Well, through the pegging, is that in essence a manipulation?
Yes.
Yep.
Yes, it is.
Yeah, but it's more about saying they're not as concerned about pegging as the level that it's pegged at.
Okay.
So if the level's all right, then you're not a currency manipulator.
Sure.
If the level is
Not working for you, then.
well, yeah, it's more if the level is too low to basically encourage more exports from China and things like that. And so I guess, as part of this, as David was saying, there's one issue on the capital side. There's the other issue is if China, in response to this, said, "Oh, great, let's just cut our currency by 10-15%," is that Trump would then treat that as
okay.
Well, let's now up the stakes on the trade war, because that's your volley back. So our next volley is whatever the next thing they're going to do is.
Okay, sure thing. I guess that's obviously from a macro perspective. Have you got anything for us from a intrinsic from the portfolios and what we do every day here at Nucleus Wealth, Damien?
Unfortunately, I haven't really got a lot on that. We're pretty much positioned for this.
Okay,
we've been
sure.
positioned for it for some time, and so I think there's a lot of these trends have been coming good, and which is why we've seen a decent amount of outperformance. We still think that the core trends are in place, and our portfolio is pretty much positioned as Australia is a hard place to be if there's worries about growth slowing globally. If there's worries about trade wars, then you don't want to be in commodity currencies, and so so we're sort of looking for exposure elsewhere.
Okay, sure thing. All right, very good. Well, on that note, we'll jump into some information about investing with Nucleus Wealth. Nucleus Wealth and the Macro Business Fund was put together to help give you access to quality, well-researched stock analysis and superior macroeconomically minded asset allocation. We use technology to help us provide a service typically only available to high net worth and sophisticated investors at a fee level that rivals the more basic solutions available to these everyday investors. We do this by using separately managed accounts, which allows clients to enjoy unparalleled transparency in what they own and why. It also means that each client effectively owns their own separate and discrete share portfolio, which is managed by us. We have partnered with Linear Asset Management, who are backed by the ANZ Bank for cash management, and JP Morgan, one of the biggest banks in the world, as custodian of your assets. We feel that this structure is the gold standard for your financial protection. In addition to this, we offer 19 separate and individual ethical screens that you can use to help tailor your investment. To ensure that your money is not being used to support companies that deal in areas and practices that you feel are important. By eliminating the areas that are only important to you, you keep the potential for higher returning areas that you might otherwise be ambivalent about, and these would typically be ruled out in broader ethical products currently available in the market. The name Nucleus comes from our ability to provide the core holdings of a client's portfolio, allowing them the time to explore areas that may be of interest or they may have experience in. We also offer a complete investment solution for those who don't have time to coordinate their own investments. Our investment team has decades of experience in world markets, and we have access to a global team of stock analysts. By removing the layers of middlemen that typically sit between your money and the markets, we've been able to reduce fees and provide unparalleled transparency in the solution we provide. For more information on what we can do for you, please call 1300 623 863 or contact us through www.nucleuswealth.com. And coming up next week on Nucleus Insights, we've got a continuation of our series on our quant investing series called Quant Rocks, and next week we're going to be looking at value. So the value side of our of how we grade our stocks, and part of that process for selecting investments in Nucleus Wealth. So same bat time, same bat channel, Thursday the 28th of June, 12:30 p.m. And as always, head over to proton.nucleuswealth.com to register your interest and be kept abreast of any updates. We are, as always, also available on iTunes and wherever you get your podcasts from on Android. Podcast Addict is one. All you need to do is just chuck in Nucleus Wealth or Nucleus Insights into the search field, and you can listen to our back catalogue rather, of webinars and podcasts. So head over there for those. And just finally, thanks for attending. As always, Maddie will be sending around our survey where you can give us a bit of feedback on how we've gone today, and of course pop up any topics you'd like to explore and present to you in the future. So on that note, thanks very much for your attendance. I hope you got something out of it. I certainly did, and we'll look forward to catching you at the next one. Cheers.